Hello, and thank you for joining us today. During this session, we will give you an overview of available capital, or Chapter 2 of the Life Insurance Capital Adequacy Test, the LICAT. Information included in this session is based on the final LICAT guideline that was published on OSFI's website in November 2017. Information included in this session comprises summary information and does not include all guideline considerations. It is therefore not to be relied upon as official guidance. Users should consult the LICAT guideline for the official text and additional specifications which may be relevant in particular circumstances. For the agenda today, first we will look at the key considerations given to available capital in the LICAT. Next, we will delve into what constitutes Tier 1 and Tier 2 capital. We will also discuss how capital instruments issued by insurers may qualify as available capital. Then, we will discuss capital composition along with the various limitations on capital that exist in the LICAT. Finally, we'll look at transition measures. So in calculating two ratios, the total and the core ratio, OSFI looks at determining if an element of capital qualifies as either Tier 1 or as Tier 2 available capital. In the LICAT, Tier 1 is viewed as the highest quality of capital, and Tier 1 absorbs losses on both a going concern basis and in a winding up. In contrast, Tier 2 is viewed to be more of a supplemental category of capital, and Tier 2 absorbs losses primarily in a liquidation or a winding up. To determine this classification of tiering in the LICAT, OSFI assesses the quality of capital elements based on their ability to absorb losses. So more specifically, OSFI looks at their availability, their permanence, their absence of encumbrances or mandatory servicing costs, and the degree of subordination. In accounting, we know that assets minus liabilities equal equity. But accounting equity is not the same as LICAT available capital. So although the starting basis for calculating available capital in the LICAT are the amounts reported in or used in calculating an insurer's equity on its financial statements, LICAT available capital doesn't include all equity components, and it may also include some financial statement liabilities. In addition, there's a number of deductions, limitations, and adjustments that are applied in determining LICAT available capital. So because, as we know, certain assets bear more uncertainty than others, these may be deducted in whole or in part from available capital. Also, adjustments are applied to limit the allowable amount of some elements in available capital. As an example, let's look, for example, at reversing amounts included in the financial statements, retained earnings, and accumulated other comprehensive income, or AOCI. And by doing so, this reflects OSFI's view that certain elements are not appropriate for regulatory capital purposes. For instance, accumulated fair value gains or losses on the effective portion of cash flow hedges reported in OCI, these are reversed from AOCI in available capital in the LICAT. To understand this a little better, we'll look at specific deductions, limits, and adjustments in more detail later in the webcast. Certain elements deducted from Tier 1 capital are added back in whole or in part in Tier 2 capital, and this reflects OSFI's assessment that these elements may not meet the higher requirements of Tier 2, although they may meet those of Tier 2. Tier 1 capital. So Tier 1 capital is comprised of a number of high-quality financial instruments that meet the criteria outlined in the LICAT guideline. These criteria are the same as those introduced by OSFI on August 7, 2014 as part of the 2015 MCCSR. There are criteria specifically for common shares and criteria for Tier 1 instruments other than common shares, for example, non-cumulative perpetual pref shares. And then in the next slides, we'll take a closer look at these qualifying criteria. So let's look at the criteria for common shares. There are a total of 13 criteria that must be met in order for a common share to be included in available capital in LICAT. Eligible common shares are viewed as the highest quality of financial instrument included in available capital. This is because if they meet the LICAT qualifying criteria, the common shares would, among other things, represent the most subordinated claim in liquidation. Their principal would be perpetual. They would not be redeemable or cancelable. They would be paid in and recognized as equity capital. And distributions would be paid out of distributable items and not in any way tied to the amount paid in at issuance. Never obligatory, and non-payment would not be an event of default. For Tier 1 capital instruments other than common shares, there are a total of 14 criteria that must be met. Eligible instruments could include those that, among others, would be subordinated to policyholders, general creditors, and subordinated debt holders, callable only after a minimum of 5 years and subject to certain conditions at that, repurchased or redeemed only with superintendent approval, perpetual without step-ups or other incentives to redeem. And if they're not issued directly by an insurer, for example, they're issued by a special purpose vehicle, an SPV, the proceeds must be immediately available without limitation to the operating entity or to the holding company in the group in a form which meets or exceeds all of the qualifying criteria. Given this, all innovative Tier 1 instruments issued prior to August 7, 2014 do not qualify as Tier 1 capital in LICAT. We'll look at transition measures for these and other instruments later in the webcast. So at this point, we've discussed Tier 1 financial instruments, but Tier 1 capital also comprises elements other than financial instruments. So this includes, for example, contributed surplus, adjusted retained earnings, adjusted AOCI or accumulated other comprehensive income, amounts for participating accounts, amounts for non-participating accounts for mutual companies, as well as Tier 1 elements other than instruments attributable to non-controlling interests. Now we can look at deductions, limitations, and adjustments. So as to ensure that only very high quality elements are recognized in Tier 1 capital, the LICAT specifies a number of deductions, limitations, or adjustments from Tier 1 capital. These include goodwill, intangibles, investments in own Tier 1 capital, reciprocal cross-holdings of Tier 1 capital of banking, insurance, and financial entities, deferred tax assets or DTAs, net defined benefit pension plan assets, encumbered assets, cash surrender value deficiencies, negative reserves, Tier 1 investments of controlled non-life financial corporations, policy liabilities ceded under unregistered reinsurance arrangements, and purchase options for which the insurer elects a deduction under Section 5.2.3.3 of the LICAT. So let's look at some of these in more detail to understand them a little better. Let's look at goodwill and intangible assets to start. So these assets are reported on an insurer's balance sheet, and they're difficult to value, especially during and after a stress situation, as they are subject to write-downs. So, for example, the value of intangible assets, including computer software intangibles, may be highly correlated to that of the insurer. Therefore, in a period when the insurer is under stress, their decreasing value would have a negative impact on the insurer's capital, thereby increasing the stress on the insurer. As a result, goodwill and tangible assets are fully deducted from Tier 1 capital. Let's look at other examples. Investments in own Tier 1 capital, for example, treasury and reacquired stock, and reciprocal cross-holdings of Tier 1 capital of financial entities may artificially inflate the capital position of insurers. These investments, whether held directly or indirectly, are deducted from Tier 1 capital, of course, unless they are already derecognized under IFRS. If we move on to look at DTAs or deferred tax assets, the LICAT breaks down DTAs into two types. The non-temporary DTAs, for example, those related to tax credits and loss carry-forwards, and temporary DTAs, which are those arising from temporary differences. A DTA non-temporary bears more uncertainty. So given this, it is 100% deducted from available capital. However, temporary DTAs, or those relating to timing differences, bear less uncertainty and therefore may be included in available capital, but only up to 10% of the insurer's net Tier 1 capital. Any DTAs included in available capital will be subject to a 25% credit risk factor. Now let's look at encumbered assets. Encumbered assets may not be available to protect policyholders, especially during a period when the insurer is under stress. The deduction for encumbered assets is calculated as the difference between the value of the assets and the sum for each pool of encumbered assets and the liabilities they secure, of the value of on-balance sheet liabilities, and any marginal capital requirements, and these are floored at zero. For example, an insurer may pledge securities or real estate as collateral to a counterparty in order to participate in certain activities such as mortgage borrowing or for posting regulatory deposits. Some assets are excluded from the deduction for encumbered assets. So these include those relating to off-balance sheet securities financing transactions, such as securities lending and borrowing, repos and reverse repos, that do not give rise to any liability on the balance sheet, and assets pledged to secure centrally cleared and non-centrally cleared derivatives. So all derivative liabilities would be excluded from this deduction. And finally, the deduction is also adjusted for a reduction of 50% of the calculated deduction amount relating to real property pledged to secure mortgage borrowing activities. Now let's look at cash surrender value or CSV deficiencies. Cash surrender value deficiencies are calculated on an aggregate and grouped basis. That is, in aggregate, policies with and without cash surrender value deficiencies are taken together and policies are grouped by product type. It is then the aggregate net deficiency of each group that's deducted from Tier 1 capital. So this is due to the fact that cash surrender values may be payable at the policyholder's discretion, and therefore they may reduce the amount of assets available for protection of other policyholders. And that is why they would be deducted from available capital in the LICAT. Negative reserves. Negative reserves depend on future profitability and are deducted from Tier 1. For LICAT purposes, these are calculated on a policy-by-policy basis. Individual Canadian life and health business may be adjusted by a percentage factor of 70%. and then further reduced for amounts that may be recovered on surrender. For example, the LICAT outlines these as commission chargebacks, marginal insurance risk requirements, and policies assumed under yearly renewable term or YRT treaties. These deduction offsets, however, are subject to a limit, and this limit is outlined in section 2.1.2.9 of the LICAT guideline. There are also other deductions included in this section of the guideline, and they would include, for example, net defined benefit pension plan assets reported on the insurer's balance sheet, Tier 1 investments of controlled non-life financial corporations, so that is in a subsidiary deconsolidated and reported using the equity method of accounting for LICAT purposes, all requirements for liabilities ceded to unregistered reinsurers, and finally, purchased options for which an insurer elects a deduction, and that's a deduction that would be an election, that would be made under section 5.2.3.3 of the LICAT guideline. So earlier I mentioned that there may be certain limits on certain elements that may be included in available capital. So on this slide, what we'll do is we'll look at an example of what could be limited in terms of inclusion in available capital. Tier 1 instruments issued by a consolidated subsidiary and held by third-party investors, and Tier 1 elements other than capital instruments attributable to non-controlling interest are subject to a limit test. And this limit test in the guideline is referred to as the third-party share or the TPS limit. So as a result of applying this limit, these elements may only receive certain limited recognition in available capital. The limit is outlined in the LICAT and is determined by comparing all instruments issued by consolidated subsidiary and held by third parties against the subsidiary's available capital and surplus allowance, and then multiplying this amount, this third-party share percentage, by the sum of the subsidiary's marginal capital requirement plus its total deductions from available capital. So we have in Chapter 1 of the LICAT, we have a list of approximations, and one of those approximations notes that insurers may approximate standalone capital requirements used in calculating a subsidiary's marginal capital requirement. So up until now, we've talked about available capital in general, and then we focused on Tier 1 capital. At this time, let's switch over to Tier 2 capital. Tier 2 capital is comprised of instruments that do not have the same level of quality that Tier 1 instruments do. So for example, we would think of instruments like subordinated debt or hybrid instruments that may not be permanent, or they may not be as deeply subordinated as, for example, as common shares or preferred shares. Also in Tier 2, we look at instruments that have a maturity. And then if they do have a maturity, they are subject to straight line amortization in the final 5 years prior to maturity, or the effective dates governing retraction or redemption rights. So we have this amortization requirement for Tier 2 instruments because by having this, it recognizes the limited life, or if you want to say it in a different way, the lack of permanence of these instruments, of these Tier 2 instruments, and it incentivizes insurers to replace the instruments as they approach maturity or otherwise end of life, when they would not be available to absorb losses. Earlier we looked at the qualifying criteria for Tier 1 capital, so now on this slide we'll look at the qualifying criteria for Tier 2 instruments. Tier 2 instruments meet the Tier 2 qualifying criteria outlined in the LICAT guideline. As previously mentioned in the Tier 1 section we went over, these criteria are the same as those introduced by OSFI on August 7, 2014 as part of the 2015 MCCSR guideline. For Tier 2, there are a total of 9 criteria that must be met for an instrument to qualify as Tier 2 in available capital. Eligible Tier 2 instruments must, among other things, be subordinated to policyholders and general creditors, have no investor rights to acceleration of repayment, except, of course, in bankruptcy, insolvency, wind-up, or liquidation, and they must have a minimum period to maturity of 5 years. When we look at the qualifying criteria, we note that there are some criteria that are common for Tier 2 instruments and for Tier 1 instruments other than common shares. For example, all of these instruments, they cannot be secured or covered by a guarantee of the issuer or a related entity. They cannot have any step-ups or incentives to redeem. They may only be callable after a minimum of 5 years, subject to certain conditions. And if they were issued by a special purpose vehicle or an SPV, they must have the proceeds immediately available without limitation to the operating entity or to the holding company in the group in a form which meets or exceeds all of the qualifying criteria. So we've talked about Tier 2 instruments, and now let's look at Tier 2 elements other than financial instruments, just like we did for Tier 1. When we look at these elements other than financial instruments in Tier 2, you'll note that these are those that OSFI determined that were not of sufficiently high quality to qualify as Tier 1, or they're deducted from Tier 1 capital and added to Tier 2. So these would include 100% of the negative reserves that were deducted from Tier 1, 75% of the cash surrender value deficiencies deducted from Tier 1, 50% of the net defined benefit pension plan asset deducted from Tier 1. We also look at including in Tier 1 the ongoing adjustment amount to amortize the impact of the net defined benefit pension plan liability asset. And finally, we can include the share premium resulting from the issuance of instruments included in Tier 2. Now if we look at what's deducted from Tier 2. So elements deducted from Tier 2 capital are the same as those deducted from Tier 1, but that relate to Tier 2 capital. So this, for example, this includes investments in own Tier 2 capital, the Tier 2 investments of controlled non-life financial corporations, and reciprocal cross-holdings of Tier 2 capital of financial entities. We also would like to mention here that Tier 2 capital cannot be reduced by deductions to an amount lower than 0. So in other words, if the total of all the Tier 2 deductions exceeds gross Tier 2, then the excess must be deducted from net Tier 1 capital. On this slide, we have an example, a simple numerical example to calculate available capital. It illustrates that total available capital is the sum of Tier 1 and Tier 2 financial instruments plus Tier 1 and Tier 2 elements other than financial instruments, and that this is then net of certain deductions and adjustments applied to Tier 2 or to Tier 1 capital. We see that the example summarizes everything we've talked about up to this slide in the webcast. We also wanted to mention that the LICAT imposes certain capital composition requirements and limitations to capital elements. Not everything that qualifies can automatically be included because there are some limitations and capital composition requirements. So, for example, the LICAT requires that common equity and policyholders' equity for mutuals has to be the predominant form of an insurer's Tier 1 capital. And the requirement is that this predominant form be at least 75% of net Tier 1. In addition, Tier 1 instruments other than common shares cannot exceed 25% of net Tier 1. Finally, Tier 2 should not exceed net Tier 1. And we've talked about net Tier 1 earlier. Net Tier 1 is equal to gross Tier 1 less the Tier 1 deductions. When we're looking at the transition measures, you have to keep in mind what was mentioned earlier, where we mentioned that in order to be eligible for inclusion in available capital, all instruments issued on or after August 7, 2014 are required to meet the qualifying criteria for common shares, for Tier 1 other than common shares, and for Tier 2 instruments. We went over the qualifying criteria for those instruments in this webcast. For instruments issued prior to August 7, 2014 that are currently included in available capital, but that don't meet the qualifying criteria, then we've developed transition measures for these instruments. These transition measures could apply to instruments that, for example, previously qualified as an innovative instrument, maybe it had step-ups or other incentives to redeem, or qualified as Tier 1 but wasn't perpetual. The transition measures outlined in LICAT section 2.4.1 apply only to instruments issued prior to August 7, 2014 that don't meet the LICAT qualifying criteria but met the previous, that is before August 7, 2014, MCCSR guideline criteria. These instruments continue to be recognized in available capital until the earlier of the instrument's first par call date or effective maturity date. We have also developed transition measures for instruments issued by subsidiaries and held by third-party investors. Specifically, LICAT section 2.4.2 applies to instruments issued prior to August 7, 2014 and subject to transition under section 2.4.1 or to those issued prior to September 13, 2016 and that meet the LICAT qualifying criteria. So it's important to note the difference here between the two bullets with the OR qualifier. So the transition measures outlined in section 2.4.2 allow for these instruments to continue to be recognized in available capital. That is to say, they will not be subject to the third-party share limit, the TPS limit we explained earlier. The transition extends to the earlier of the eligible instrument's maturity or redemption, the first par call date, or if the instrument is perpetual, 10 years. This concludes this information session on Chapter 2 on available capital. If you have any questions about the material discussed or any other areas of the LICAT guideline, you're welcome to correspond with OSFI using the email address information@osfi-bsif.gc.ca. Thank you.